Hello Accounting 101 students. In this video, we are going to cover some of the topics that are in Chapter 10. And Chapter 10 in particular has a lot of topics because we're covering all of our liability accounts in one chapter. So the first question we're going to start off with on question 1 deals with our sales tax payable, which is a current liability account. And in this problem, we are told that Greenspan Supply does not segregate between sales and sales taxes at the time of sale. And they tell us the register total of $11,880, and all sales are subject to a 8% sales tax. So we need to be able to compute the sales tax payable, and we also need to make the entry to record the sales tax payable and record the sales. So one thing I want to point out is that we determine the sales tax payable by taking the sales revenue times the sales tax rate. So that's how we're going to determine the amount of the sales tax payable. And in this problem, they tell us the register total is $11,880. So that is going to be the amount of the cash that we receive. And the cash that we receive is going to be recorded as a debit. And now we need to segregate that amount between the sales revenue and the sales tax payable. So that means that the cash amount is equal to the sales revenue plus the sales tax payable. So in this example, we know that our sales revenue is going to be 100% because we're going to have to record all of the sales revenue. And our sales tax payable is 8% because that is our sales tax rate. So the total cash received is going to be 108%. And that's just a little shortcut to help us solve through this problem, okay? So that means that our cash received of $11,880 equals 108% of X dollars, because we don't really know what our sales revenue is in this case. So we can solve for X, which is our sales revenue, by taking 11,880 divided by 1.08. So in your calculator, you want to take 11,880 divided by 1.08 to get 11,000. And this 11,000 is going to be the amount of your sales revenue. So this sales revenue is going to be 11,000. And now if you take the 11,000 sales revenue and multiply that by the 8% sales tax rate, you're going to multiply this out and get 880. And this will be your sales tax payable. And you'll notice that this is the formula that I started off with at the top. Sales tax payable equals sales revenue times the sales tax rate. And the last thing that you want to do in this problem is check your work to verify that this relationship really holds true, right? If you take your sales revenue of 11,000 plus your sales tax payable of 880, you'll notice that this equals the cash amount of 11,880. So that's how you can make sure that you've calculated this correctly. And this relationship holds true, right? Because you're able to see that your sales revenue, 11,000 is what you've solved for, plus the sales tax payable of 880, which is the 11,000 times that 8% rate gives you your 880, equals the cash amount that we were given in this problem. One of the things that I want to share with you is this website, which is the California Department of Tax and Fee Administration, because sometimes students wonder, where does that sales tax payable go? So in California, retailers that are engaged in business need to register with the California Department of Tax and Fee Administration to pay the state sales tax, which applies to all of the retail sales of goods and merchandise except for those sales that are exempted by law. So the sales and use tax rate in specific California locations has three parts. We have the state tax rate, the local tax rate, and any district tax rate that may be in effect. In the next question, we're going to go over the salaries and wages expense and the salaries and wages payable. So this is an important topic. You really want to make sure that you go through our textbook to really understand the journal entries for the salaries and wages expense and the salaries and wages payable, as well as the payroll tax expense, which is a separate journal entry. So far in this class, we learned that we have sales, salaries, and wages expense recorded as a debit, and salaries and wages payable recorded as a credit. And we need to realize that sometimes there are deductions from a paycheck causing differences between the salaries and wages expense and the salaries and wages payable. And the reasons for the deductions is for the taxes that need to be paid. So the salaries and wages expense is going to report the gross earnings, and the salaries and wages payable is going to report the net earnings or the net pay. So that's the amount that you actually receive in your paycheck or the direct deposit. And the other things that are deducted from an employee's paycheck will include federal income taxes payable, state income taxes payable, and then we have FICA taxes payable, which is basically going to include your Social Security and Medicare, and the state disability insurance. So we have a few different things that are going to be deducted. There's also going to be a payable because the company doesn't have to keep this. In addition, depending on each employee, there might be some additional amounts that are deducted, such as medical insurance, dental insurance, and you might have a 401k retirement plan, and so forth. So there could be some other deductions that are not covered in this particular problem, but I wanted to mention that because you want to be aware that there could be some other deductions from your paycheck, which results in a difference between the gross earnings and the net pay. Okay. So in this particular problem, we're not going to focus on the journal entry. We just want to come up with the dollar amounts for the gross earnings and the net pay. So I'm going to use part of this journal entry, but not the entire journal entry for this particular problem for that reason. So we have Betsy Strand's regular hourly wage is $20. So that's her regular hourly wage. And then we're told that she receives an hourly wage of $30 for work in excess of 40 hours. So that is referring to the overtime pay, which is typically at a time and a half. Okay, so during the January pay period, Betsy works 46 hours. So Betsy works 46 hours. This 46 hours is now going to be split up between the regular rate of $20, which is going to be applicable for the first 40 hours worked. So we're going to take 40 hours times $20 to get us $800 earned. And then we're going to have 6 hours at $30. So that equals $180. So the total amount that Betsy has earned is going to be 46 hours total. And when we add up both of these, we're going to get our 980. And this 980 is the gross earnings. So that's the first part right here. And when we think about this problem and the journal entries, we're going to have 980 as the gross earnings. But remember, she's not going to receive the full 980 because of these deductions. So in this problem, we have the federal income tax withholding at $97. And they're telling us in the problem that there are no voluntary deductions. They didn't tell us the state income taxes payable, but they did tell us the FICA rate. So we're going to only use the pieces that we need to in this particular problem. We're not going to consider the state income taxes payable or the disability or any other deductions. So now we need to determine the FICA taxes payable. So we can do this by taking the 980 times 0.0765 because we look at our FICA rate. So this is 74.97. And then for our FICA taxes payable, I'm going to include in our 74.97. And then when we think about our salaries and wages payable, we only need to look at the dollar difference, and that's going to be our net amount, which will be 808.03 when we take our 980 minus 97 minus 74.97 equals 808.03. So you can see that will be our net pay. So thank you for taking the time to watch this video, and I recommend reading through the textbook for the journal entries, not only for recording the salaries and wages expense and the salaries and wages payable at each time period, but also being able to record the journal entry for the payroll tax expense, as well as the accrual at the end of each month for the days that have not been paid yet. All right, thank you.